are all down, but a big uptake on an NCX, which is now up 3%. HCL Technology is up 1.5%. Metropolis, UBL, Divi's Labs, InPTCS marginal uptake coming in there. So sectorally, it's IT, which is sort of resilient in an otherwise weak market today. But let's try and figure out what's the trend really emerging from banking and financial services. Nitin Aggarwal joins in on the show right now to talk about exactly that. Nitin, hi, morning. Good to have you on the show. Just looking at the trend that's been emerging across the second quarter updates, right, wherein the loan growth has been strong. What's really stood out for you amidst the Q2 updates that have come in?
Yeah, hi, good morning. Thanks for inviting me. So yes, this is going to be another steady quarter, what we are looking at in terms of earnings. While first quarter was exceptionally strong and more so for PSU Bank, which reported collectively more than 100% growth. And we know for a fact that margins over the year are going to moderate. We have already seen the cycle turning in the first quarter, and which is where the earnings will also begin to moderate as you go forward in the year. But at least for second quarter, we are still looking at it over 25% earning growth for the sector. And that is adjusted for HDFC merger. And so private banks therefore are going to report over 25% growth, and PSUs will also be close by somewhere in the early 20s. And this will be driven by a combination of steady loan growth, what we are looking at. And while margins will moderate this quarter again, but that will get balanced by the further improvement in the provisioning for these banks.
If HDFC is talking about a credit growth, and this is the last number which came out a couple of days ago, the quarterly update, they are talking about a credit growth north of 20%, 23 to 24%. So can we safely assume that for mid-tier it would be at least 30% plus?
Sorry, mid-year you are saying 30% plus?
Mid-tier, yeah.
Mid-tier. Okay. So I think cannot really extrapolate, I think, like that, because if you look at some of the mid-cap banks and mid-sized banks have already reported the business update, and the performance has been still mixed over there. Within the key names that we cover, if you look at Federal Bank has reported close to 5% sequential growth. So that's very similar to where HDFC Bank is, and which is where the growth momentum will remain healthy. We are looking at a 14 to 15% credit growth for FY24, and again around 14% number in FY25 is what we are working with in our estimates. And I think these private banks, the range can be between 17 to 20% as of now what we are looking at. Very few banks like say Equities or AU will be doing a number which will be going to be higher than that in terms of the growth range that we have.
Do you see the war of liability, which in a sense has been a constant feature for banks, having impact on the NIMs further?
That is a possibility, yes, and it cannot be ruled out because we are seeing very intense competition for deposits across banks. The CD ratio for banks and as a result for the system now has increased sharply, and I think looking at how the recent events have panned out, which has further sort of resulted in a uptick in the bond yields, and any possibility of rate cut that we were looking at later during the year is getting deferred a bit, and which is where the rates can remain elevated for slightly longer than what they otherwise could have been, and which is where I think the funding costs can continue to inch up over the year, and margins therefore may report a downtick over the coming quarters. That possibility of a competition for liabilities is very much there.
Sure. Nitin, I want to talk about some of these large private banks, right, and the recent state of underperformance that we've seen pretty much across the board. Now, HDFC Bank has, loan growth and deposits, actually a decent uptick coming in the second quarter number. What is the concern then for the market? What do they think is at risk? I mean, do they think that it cannot grow on such a large base and it will not really multiply the same way as it did when it was a standalone entity, HDFC Bank?
Yeah, so certainly this has been one of the concerns for the street, and while we have been optimistic in terms of the ability of the bank to execute, after all they have been doing it for over 25 years, but just because post the merger the size of the balance sheet has increased dramatically, and they need to therefore raise a lot of liabilities, both to retire the borrowings as well as to fund the growth. While Q2 has business update has given a comfort to market that the bank can execute at that scale, But I think investors will want to watch out the execution over the coming quarters before completely aligning with that view. Because historically we have seen the bank doubling the balance sheet in close to 4 years. While the guidance on that from the management remains unchanged, and they're still looking to double the bank in the next 4 years broadly. But I think the execution in the coming quarters will be important. And this being the first quarter when the bank will be reporting the merged entity numbers. And we know that they will be reporting some compression on the margins to begin with, while the business growth numbers are out and they are very healthy. And but the recovery, therefore, on how the margin pans out in the coming years will be important to assess a view as to how quickly bank can move back to the 2% ROA, which is where it was pre-merger.
Traditionally, you've always preferred PSBs in amongst the private players, ICICI Bank. Has that really changed, and do you see value on the table in any other names too?
I think yes, PSBs, we have been going pretty positive over the last couple of years. We upgraded Bob in 2021, mid-21 at around 80 rupees. And the entire pack overall, if you look at, has done quite well. And that, I think, while you will see consolidation in these PSBs time and again, but the broader underlying fact that the ROAs are going to sustain at burn, and they will possibly move up in the near term or probably over FY24 and 25. And which is why the sector has been very resilient and they keep bouncing back after every round of consolidation. And now that we are looking at broadly around 17% average ROE from PSBs, over FY24, 25, and multiples still look to be like most of them are still below 1 in terms of the price to book multiples. And that leaves still a scope for further re-rating in these banks. And we continue to like the top names like SBI, Bob and Canara in PSBs.
What about some of the payment companies, the likes of a Paytm or an SBI Cards? How do you think one should be looking at them in terms of the overall valuation metric as well, the earnings-based valuations?
Yeah, so yeah, we cover both the names, and SBI Card has been like over the last couple of years, the performance has been a bit subdued, and that's primarily because the revolve rate for the entire industry has come down, and margin for SBI Card has moved down considerably from what it used to be. And now that the funding cost is looking to get stabilized, and incrementally, possibly from Q3 and Q4, you will see gradually NIMs begin to expand on a more calibrated rate. And on the asset quality side, there has been some uneven performance. Last quarter also we saw an uptick, and which company attributed to the specific cohort. I think as these issues get sorted and the credit cost begins to recede, you can see a stronger earnings growth, and that will get reflected in the stock multiples on SBI Card. So we like the company, but I think it will be another sort of a range-bound performance in the very near term, and thereafter it can do well, backed by the stronger earnings growth in FY25 is what we look at. And Paytm, another company that we initiated in April. So the stock has done quite well. It's almost a 50% since our IC. And I think going forward, while the metrics are of course tracking well, we are seeing a stronger run rate on devices, on MTUs, and even the GMVs and the loan or disbursements. All these metrics are tracking well. But of the recent, the regulatory concern on some bit on the personal loans and the unsecured loans, which the governor also talked about in the recent policy meet. And so that has been a bit overhang on the overall growth rate in the sector overall. And but otherwise, I think the company is on track to achieve a bit of break-even in FY25 by the second half of FY25. So which is going to continue to like the company from a long term.
Okay, and what about your outlook when it comes to some of the life insurers, given that it is an environment where there is quite a bit of competition too, with the savings products rates to have gone up substantially? What's your outlook?
Yeah, I think life insurance sector has seen some bit of pain around the budget time when the government changed the rules for the high ticket policies in terms of taxation. And the sector has seen a recovery in terms of growth, and mainly in the second quarter. And this quarter we are looking at a relatively better AP growth and feeding into the VNB growth. Well, the margins, we are not expecting that to be a driver of VNB anymore, but we think that steady premium growth, because the overall the sector is still quite underpenetrated. And the new product lines which are going to build up and expand is going to drive the growth for the sector over the next many years. And which is where there is a structural story in the insurance, and therefore the VNB growth can sustain around 18%. And some of them are trading quite compelling in terms of valuations because the ROEVs are very steady, closer to 20 or 20 plus also for some companies. And this quarter in particular, there could be an EV uptick because of the entire market movement that we have seen. So we like the space overall, and SBI Life is the top pick for us in the space.
All right, thank you so much for joining in and giving us an all-round view on how things are shaping up within the entire banking and financial space. A quick check-in on the index, and for now holding out around the 19,550 mark, actually just at that level as we speak. 328 points down on the Sensex, but it's the broader market that are seeing